The lure of the moving average. In this video, we are going to reveal the absolute best strategy that you can implement right now using the moving average indicator. Moving averages are undoubtedly the most famous technical indicators in the entire trading world. If you have any trading topics you'd like to discuss, just press 2 inches, comment, I'll clear things up for you. Almost every beginner starts their journey here, attracted by the clean, smooth lines that seem to make market trends incredibly easy to read. But despite their popularity, the harsh reality is that most traders are actually using them the wrong way. The core strategy we are discussing today is known as the moving average crossover. It is a very simple and historically famous trend-following strategy. In theory, it is beautiful. When a faster moving average crosses above a slower moving average, it signals an uptrend, and you buy. When the faster average crosses below the slower one, it signals a downtrend, and you sell. It sounds incredibly easy, yet this is the exact trap where most retail traders end up losing their entire accounts. Part 1. The 2 biggest crossover mistakes. Let's analyze the biggest mistakes that traders make when executing this strategy. Mistake number 1. Instant execution on crossover. The moment the lines cross, retail traders immediately open a buy or sell position. They think the crossover is a magic trigger. However, this only works when the market is in a strong, sustained trend. In a trending market, crossovers can catch massive moves, but markets only trend about 30% of the time. 70% of the time, the market is in a range-bound, sideways phase. In a range, price bounces back and forth between support and resistance. Because moving averages are lagging indicators, meaning they calculate past price data, they will flatten out and cross over each other repeatedly inside a range. If you buy and sell every single crossover in a ranging market, you will get hit by dozens of false signals in a row, which will wipe out your account incredibly fast. Mistake number 2. Using too many moving averages. Many traders believe that if 2 moving averages are good, then 5 or 6 must be better. They load their charts with a 10, 20, 50, 100, and 200 period average. They wait for all of them to cross over and align before entering a trade. This is a massive mathematical mistake. Every single moving average you add to your chart increases the total lag of your trading system. Let me show you what I mean. Let's say you're using a simple system with just 2 moving averages, the 2-0 period and the 5-0 period. When the 20 crosses above the 50, you get a buy signal. Now, look at what happens if you add a third, slower moving average like the 2-0-0 period. If you wait for the 20 and 50 to also cross above the 2-0-0 period average before you buy, your entry signal is delayed significantly. By the time all 3 averages align, the trend is often already exhausted, and you end up buying right at the top. The lesser the averages, the better the signal. Part 2. The correct way. Higher time frames and historical reaction. Now, let's discuss the third major mistake. Trading on lower time frames. Lower time frames, like the 5-minute or 1-minute charts, are filled with market noise. These time frames have very short-lived trends and are dominated by range-bound conditions. If you try to trade crossovers on lower time frames, you are guaranteed to fail. Instead, you must trade on high time frames. We highly recommend the daily time frame, or at a minimum, the 1-hour time frame. So, how do we trade the crossover the correct way? First, we only use 2 moving averages, the 2-0 period exponential moving average EMA and the 5-0 period exponential moving average EMA. We use EMAs because they place more weight on recent price data, reducing the lag compared to simple moving averages. Next, before we trade any currency pair, we must analyze how that specific market reacts to crossovers historically. Every market has its own unique personality. Some currency pairs trend smoothly, while others are incredibly choppy. Look at this XAU 2-hour chart. If we look left, we can see that when the 20 EMA crossed below the 50 EMA, the price immediately reversed and went up instead. It did this multiple times. This pair has a history of generating false crossovers. If a market has a history of bad crossover reactions, we simply do not trade it. Instead, we look for a market that respects the crossover. Look at this XAU $1 hour chart. Historically, whenever the 20 EMA crosses the 50 EMA, the price immediately follows the direction of the crossover and starts a powerful, sustained trend. This historical alignment is your filter. By only trading markets that have a proven track record of respecting the moving averages, you instantly eliminate the majority of your losing trades. Part 3. Surgical exits using the ATR trailing stop. Once you have selected the right market and get your entry signal, how do you manage the trade? Most crossover systems tell you to wait for the moving averages to cross back in the opposite direction before you exit. This is a massive mistake. Because moving averages lag, waiting for a crossback means you will give back most or even all of your open profits before the exit signal is generated. Look at this example. You buy here on a bullish crossover. The price rallies beautifully, giving you a huge open profit. But then the market starts to reverse. If you wait all the way until the 20 EMA crosses back below the 50 EMA to exit, you end up closing the trade near your entry point, wasting hundreds of pips. This is why we use a much better, non-lagging exit indicator, the ATR trailing stop loss. The average true range ATR measures market volatility. An ATR trailing stop places a dynamic line below your buy trade. As the price moves higher, this line automatically moves up with it, keeping a safe distance based on the current volatility. The moment the price reverses and breaks below this ATR line, you exit the trade immediately. As you can see, using the ATR trailing stop gets you out of the trade much earlier, protecting your hard-earned profits and keeping your pips intact. Part 4. The 200 EMA filter, the ultimate win rate booster. Now, let's discuss the ultimate way to use a moving average as a global trend filter. You can take almost any standard trading indicator, combine it with the 200 period exponential moving average, EMA, and instantly boost its win rate. The 200 EMA acts as the dividing line between a bull market and a bear market. It tells you the macro direction of the institutions. The rule is incredibly simple, yet highly powerful. Rule number 1. If price is above the 200 EMA, you only take buy signals from your indicator, and you completely ignore all sell signals. Rule number 2. If price is below the 200 EMA, you only take sell signals, and you completely ignore all buy signals. By doing this, you ensure that you are always trading in alignment with the major institutional flow. Let me give you a statistical proof. Let's look at the parabolic SAR indicator. If you trade the parabolic SAR blindly on the 1-hour chart, taking every single buy and sell signal, it has a backtested win rate of only 38%. This is a losing system. But look at what happens when we add the 200 EMA filter. By only buying when price is above the 200 EMA and only selling when price is below it, the win rate immediately jumps to 46%. Let's look at another famous indicator, the super trend. Trading the super trend alone gives you a win rate of 39%. However, when you add the 200 EMA filter, the win rate is boosted to 48%. This simple filter takes a losing, unprofitable retail indicator and transforms it into a highly profitable, institutional-grade strategy. Part 5. The 200 EMA in action, multiple case studies. Let's look at how we combine this in real time. On this XAU $1 chart, we have our orange 200 EMA on the screen. The price is trading firmly below the 200 EMA, meaning we are strictly in a sell-only environment. When our supertrend indicator generates a buy signal, we do not take it. We ignore it completely. But when the supertrend generates a sell signal, we execute our trade immediately. Look at how cleanly the market delivers. Because we are trading with the macro institutional flow, the sell trades move rapidly in our direction with almost zero drawdown. Now look at a buy scenario on this XAU. The price is trading above the 200 EMA. When the supertrend generates a sell signal, we ignore it. When it generates a buy signal, we enter long. The trend continues upward cleanly, hitting our target with ease. The secret to consistent growth. I have just given you the absolute best moving average strategies that you can implement into your trading system right now. All I ask in return is for you to take 2 seconds of your time to like this video, subscribe to the channel, and hit the notification bell. It takes only 2 clicks, but it means the world to our team. Study these rules, practice them on your charts, and we will see you in our next trading masterclass. If you have any trading topics you'd like to discuss, just press 2 inches. Comment, I'll clear things up for you.